welcoming you to Skilled MBA Case Study Series in Accounting. Evaluating mutual fund performance requires a deep dive into risk-adjusted metrics. Simple returns can be misleading. Instead, focus on metrics like the Sharpe Ratio, which considers both risk and return. This approach provides a clearer picture of a fund's true performance, essential for making informed investment decisions. A fresh Master of Business Administration graduate is tasked with analyzing 3 large-cap mutual funds. The expectation is to delve deeper than surface-level performance metrics. The goal is to evaluate these funds using risk-adjusted performance metrics, providing a comprehensive understanding of their true performance and risk exposure. High returns can be deceptive if they stem from excessive risk. 2 funds may show identical returns, yet their risk profiles could differ significantly. Evaluating risk-adjusted performance is crucial to understanding the true value of an investment, ensuring that returns are not overshadowed by potential risks. Understanding the risk-return relationship is crucial. Calculate absolute and relative returns over time. Assess risk using volatility, standard deviation, and beta. Apply risk-adjusted metrics to balance returns against risks. This analysis guides investment decisions, helping select funds with optimal risk-adjusted performance. The Sharpe Ratio assesses excess return per unit of total risk, with higher values indicating superior risk-adjusted performance. The Treynor Ratio focuses on excess return per unit of systematic risk, ideal for comparing similar funds. Jensen's alpha evaluates performance against expected returns, where a positive alpha signifies outperformance relative to risk. To understand the Sharpe Ratio, first calculate excess return by subtracting the risk-free rate from the fund's return. Next, measure volatility using the standard deviation of fund returns. Finally, compute the ratio by dividing the excess return by this standard deviation, providing insight into risk-adjusted performance. Identify excess returns by calculating the fund's return above the risk-free rate. Measure beta to assess the fund's sensitivity to market movements. Determine the Treynor ratio by dividing the excess return by beta, providing a risk-adjusted performance metric. To unpack Jensen's alpha, start by predicting the expected return using the capital asset pricing model, which considers risk. Measure the actual return over the same period. Calculate alpha by subtracting the expected return from the actual return. A positive alpha suggests the fund manager has added value beyond market exposure. Fund A achieved the highest annual return at 18%, but with a high standard deviation of 24% and a beta of 1.2, indicating higher risk. Fund B, with a 15% return, showed superior risk-adjusted performance with a Sharpe ratio of 0.81 and a Treynor ratio of 14.4. Fund C balanced risk and return, achieving a 16% return with moderate metrics. Fund B excels in risk-adjusted performance, boasting the highest Sharpe and Treynor ratios, indicating superior risk efficiency despite lower absolute returns. Fund C offers a balanced approach with moderate risk and return, maintaining decent risk-adjusted metrics. Fund A, while achieving the highest absolute return, suffers from excessive risk, reflected in its lower risk efficiency. Fund B emerges as the optimal choice for balanced growth, offering the most efficient risk-return profile. Despite not having the highest absolute return, its superior Sharpe and Treynor ratios highlight its risk-adjusted performance, making it a prudent investment decision. Master of Business Administration graduates can leverage their academic foundation to apply theoretical finance concepts in real-world investment decisions. Mastering essential metrics like Sharpe Ratio and Treynor Ratio is crucial for professional fund managers. Effective client communication is key to explaining complex risk-return concepts, while constructing optimized portfolios based on risk preferences enhances investment strategies. High returns are insufficient without assessing associated risks. Master key metrics like Sharpe Ratio, Treynor Ratio, and Jensen's Alpha to evaluate risk-adjusted performance. Prioritize a balanced approach, focusing on risk-adjusted returns rather than absolute gains for smarter investing. Explore advanced metrics like the Information Ratio, Sortino Ratio, and Capture Ratios. Develop Excel templates for efficient fund comparison. Engage in investment clubs to analyze real funds collaboratively. Begin with modest personal investments to apply your knowledge practically. Thank You Skilled MBA bridges the gap between theoretical knowledge and practical application. Our courses are designed to equip you with real-world skills, enhancing your professional journey. For inquiries, reach us at +91 87553 00795 or support us skilledmba.com. Explore more at skilledmba.com.